I want to buy a home in 2026. So I'm just going to show you exactly what I'm doing to put myself in a position so I can buy a property this year. I'm going to show you how I'm preparing financially, how I'm thinking about credit, savings, how I evaluate the market and inventory, and what loan options I'm considering. I'm also going to walk you through how I think about what price range I want to be in, when it actually makes sense to get pre-approved, and what steps you should be taking before you ever hire an agent. Obviously, as a real estate agent, I'm going to represent myself, but as a buyer, there's certain things that you would want to do before you even get to the point of hiring an agent. So we're going to talk about that as well. Let's start with why I'm buying in 2026. The bottom line is it fits into my long-term strategy. My goal is to acquire a portfolio of rental properties that I can retire on. My wife doesn't want to work forever. I'm in real estate sales, and so I don't have a 401k, I don't have a retirement plan, a pension, or anything like that. And so as somebody who works in sales, when I stopped selling, I stopped making money. And so what I was taught early on when I got into this business was acquire rental properties up to a point in which the rental income that you're making covers your monthly expenses and then some. We call it a freedom number. If it costs me $6,000 a month to live, that's all my expenses, plus savings, plus discretionary income, then I need a rental portfolio that's bringing in $6,000 a month profit. I won't get into all that, but you guys get the gist. This is going to be our third property. And so realistically, I can't wait too long between each property. And so I just made the decision, it's either now or never. We either have to put ourselves in a position to buy, or we're going to just be comfortable and stuck in this house that we have now. Now, my strategy for building this rental portfolio, at least for the first couple properties, is going to be through owner occupancy. That means instead of buying a property that I don't intend to live in, which is going to require 20% down, I am purchasing a property, occupying it, living in it for at least a year, and then I'm moving out, renting out that property, purchasing another one, living in it, rinse and repeat, right? Up until the point in which my wife is tired of moving and we have to buy our forever home. And so step number one, when you're thinking about buying a property, especially in 2026, is how does this fit into my long-term goals and strategies? I'm talking about 5 years, 10 years, 15 years down the line. Having a clear idea of that makes this process a whole lot easier because it's not guesswork. You're going to be a lot more focused. So if you're not sure or you don't know, how to align your goals, that's a conversation that we can have to say, I want to get into real estate investing. I want to do something similar. I want to build a rental portfolio. How do I go about doing that? I gave you my way, but there's a ton of different ways to go about that. There's no right or wrong answer. It's just whatever works for you. Now, once you have an understanding of why you're buying, you now want to have some clarity around where you're going to buy. For me, I'm looking at either Washington, D.C. or Prince George's County. I used to live in D.C. I'm okay with moving back. I currently live in Prince George's County. I'm happy here. So I'm open to either location. The thing with DC is over time, you're going to see higher equity. And so if we can find a good deal in DC, it's going to be a better long-term play than a property in Prince George's County. And so again, with this third property, this is not our forever home. This is a home that's eventually going to be in our rental portfolio. And so I want a location, I want a neighborhood or a subdivision that's going to have strong rental parameters, a place where people are going to want to rent, a place where renters have strong qualifications, credit, income, all those things, right? These are the things that I think about now, even though I'm not going to have to worry about them for another couple years or so. But all that aside, when I'm thinking about location, it is, am I going to be comfortable here? Because I'm going to be living here for a while. Am I going to be comfortable here? Is my family going to be comfortable here? I have a toddler, so we think about school districts and things like that. Obviously, appreciation and rental capabilities. Because I'm early on in this process, there's a lot of flexibility there. So part of my research is what's coming down the pipeline in certain neighborhoods. How is this going to affect our commute to certain areas? Do these certain neighborhoods have the neighborhood features that we're looking for? We really love where we live right now, and so I wouldn't be surprised if I end up buying within a 10-minute radius of where I already am. I know the numbers work because the numbers going to work on the property that we're in right now when we rent it out. Those numbers are going to be phenomenal. So you don't need to know exactly where you're going to buy, but just have a general idea and have a good idea of what your criteria and qualifications are. Okay, we hit why, we hit where. Now it's what? What type of property am I looking to buy? Again, With this being my third property, I'm probably leaning towards a townhome. I don't want a single family rental. It's going to come with more maintenance concerns and expenses that I'd rather not have to deal with. Essentially, what I'm looking for is something that is larger than what we currently have. We do realize we need more space. It's something that's going to be easily manageable because we're not going to be there forever. So I want to put a tenant or a family in there, and I don't want too many calls in the middle of the night. I'm not primarily looking at resale value, even though it's super important. I'm going to hold this property for 10 plus years. Ideally. My wife was trying to convince me to sell our first property because we would have made, a good amount of money on it. But here's the thing with real estate. Once you sell the property, you don't have the asset anymore. All you have is cash. And there's only 4 things that you can do with cash. You can spend it, you can invest it, you can save it, or you could donate it. And so I'm not too concerned with resale value at this point. It's obviously going to be important, and I'm not going to buy or invest in a neighborhood that is trending downwards, but I don't plan on selling the property anytime soon after I buy it. And so rental potential is most of what I'm evaluating with whatever property we decide to buy. I'm not looking at condos because it just doesn't make sense for our family, and I'm not really sold on condos as an investment option. Where I'm at right now is I've made the decision to buy, and now I have to work on the financials, right? And so what lenders are looking for is credit, income, assets, debt to income ratio. That's pretty much it. So my credit right now is in the toilet. I got to be honest with you guys. The student loans that really put a hit on my credit. For most of my life, I was in the 700s and up since I was in college. I've never had a bad credit score. A year ago or whenever Trump enacted, he did something, and all of a sudden my credit took a hit. And so I'm working right now to get my credit back up. Here's the thing that you have to realize about credit. If I'm going to be on the loan, they're going to use my credit because my wife's score is higher than mine. But if I'm going to be on the loan, which is a conversation that we're going to have, then lenders look at the middle score of whoever has the lowest credit. And so a lot of people think that when you have a co-buyer or 2 people on the loan, the person with the higher credit is going to help in that scenario. That's not how it works. If I'm going to end up being on the loan, then my credit needs to be way better than it is right now. The other thing that we're working on is savings, of course. With this being our third property, I know that at minimum, I'm going to have to put 5% down. If I was a first-time home buyer, for our first home, we put 3% down, and we're able to use down payment assistance program. So if you're buying your first home, you don't necessarily have to put 5% down. You can really come to the table for a lot less than that. I know that with this being our third home, there's not going to be programs available for us. And so at minimum, we're going to need 5% for our down payment, and we're going to need to budget at least 3.5% for closing costs. Now, strategically, I would love to negotiate for some of our closing costs to get paid by the seller. That's not guaranteed. And so if I want a house and it's the springtime or the summertime and the market's super competitive, I know that it's going to be a slim chance that we're going to get closing costs paid, especially if there's multiple offers. So I don't want to bank on that. So we want to make sure that we hit our savings goals, which is going to be about 8% of the purchase price of the property. So you have to be really, when it comes to saving, you have to be really purposeful. One thing that I was taught was this idea of paying yourself first. So you have to treat your savings like a bill, like you would do anything else. Most people, they pay their bills, they pay for their groceries, and they go out and they do whatever. And then whatever's left, that's what they end up saving. Paying yourself first means put whatever money into savings, just like you would a bill. I got rent. I got my savings, I got my utilities. Those are all on the same level, right? Car payment, whatever. Those are all on the same level. And then your discretionary funds or you're going out for this weekend or you got to buy your friend a gift or, whatever, that comes after. You play with that money after, but you make sure that you save first. The only way you're really going to hit your savings goal. You can also use apps that connect to your debit card in which they put a couple cents away and they invest it. When you're saving for a home, you got to be aggressive and you need to protect that money. That money is not your savings fund. That's not vacation fund. You shouldn't even have, if you're buying a home, you shouldn't have a vacation fund. Take that vacation fund money, put it into the housing fund. If you're getting a tax refund, put that money in the housing fund. Save as aggressively as possible. So when you're ready to buy a home and you're ready to pull that trigger, you know that you're financially ready to do so. Again, the goal is to have the money in case you need it. You don't necessarily have to spend it. If we're negotiating for closing costs getting paid, or if you're a first-time home buyer and you're using a program, you still have the money, just not you're not using it for the purchase of the house. Now, the other thing too is when you buy the house, your expenses don't go away. You still need furniture if you need to make updates, the property if something breaks. You want to make sure that you have additional funds to take care of that stuff. So it goes without saying, but I'm saying it anyway. When it comes to financing, we're probably going to go conventional loan, right? Because the goal is get my credit up to a point where I can qualify for a conventional 5% down. The reason I'm doing this is because as opposed to an FHA in which I'd be able to put 3.5% down. FHA is a good loan product. However, it's a more expensive loan option than conventional. The closing costs are higher because with FHA, you pay private mortgage insurance monthly, but you also pay for it up front. It's your lender about it, but your closing costs are going to be higher on an FHA loan. And so for me, with knowing that, I want to save as much money as possible. Like I want to be throwing money out the window. And so even though we may end up buying a fixer-upper because that's what I'm into now, we're still going to do so with a conventional loan. You have the option of doing FHA 203K, which is a renovation loan that allows you to buy the property and also fund the repairs. If our credit is up, maybe we'll do a HELOC on one of our properties. We already have one HELOC out. Maybe we'll do another one to cover those repairs, or we'll just do, we got a credit card. We did that for the property that we're in right now. We funded those renovations on credit. They give you 12 to 14, sometimes even longer, interest free. It's a great way to fund your rehab repairs. A lot of people think you got to get business credit and an LLC, and you don't have to do all of that. Simple credit card. As long as you're financially responsible, you can manage the payments, then you can purchase a fixer-upper without having to finance through a renovation loan. Even though I am a proponent of renovation loans. So I would say look at both options, see what makes the most sense for you, and then explore that strategy. But either way, conventional loan is likely the option that we're going to go with. When I'm evaluating which lender I'm going to work with, guys, the rule of 3. 3 lenders within 2 weeks. If you find someone that you want to work with, cool. If not, 3 more within 30 days. I'm okay with you guys going to your credit union. I personally found that local lenders and mortgage providers and loan officers, they have better products, they have better service and better incentives. However, look at your credit unions, look at your big banks. I don't necessarily recommend Bank of America or Wells Fargo. Bank of America does have a nice grant program if you're a first-time home buyer or if you haven't owned a home in 3 years or so. Bank of America does have a nice $17,000 grant. So outside of that, I wouldn't use Bank of America, but certainly look into that. 3 lenders so you can compare fees, rates, and things like that. Don't let them know that you're shopping around, but just apply for the mortgage. Say, this is what I want to do. This is what I plan on doing. Send them all the documents that they need, W-2s, bank statements, pay stubs, whatever. Just do that 3 times, guys. I talk to people all the time who only go to one lender, and that's fine. There's nothing wrong with that. It's just not my process. And I've been doing this for a long time. Shop around for the mortgage so you can get the best terms and the best rates. It's the least you could do for yourself. Our pre-approval process is going to look a little different because we have the property that we're renting out, the property that we're living now that we're going to rent out. And so now we have to figure out, and this is a conversation that we have with the lender, what do they want to see so the debt on our current property is not used against us, right? Because we have a mortgage already on this current property. The mortgage on the first property is covered via rent, so we know that that's fine. That's not going to be an issue for us. But what do typically they need to see a lease and security deposit or some type of rent? If that's the case for the property that we're in right now, we have to get that process moved along. And so if we know that in order to get qualified for a property that the current house has to have a lease on it, then we know if we're looking to buy in, let's say July, for example, our property has to be marketed for rent by May. So we can get tenants in, we can go through that process to make sure that we have somebody who is willing to sign a lease and submit a security deposit for our property. Now, that's a whole nother thing because there are a couple things that we need to do with our current property. For example, we know that we need to update the windows on the property. When we purchased the property initially, that was something that came up on the home inspection report. And so it was that and the roof. We got the roof fixed. We got the roof replaced actually. And so now we know that we have to replace some of the windows in the property. So that's one of the things that we know we need to do before we buy. So that's also on my list of things to get done. Now, when it comes to price range, I feel like I'm beating a dead horse by saying this, but I tell people all the time, I tell my clients all the time, the two most important numbers when it comes to buying a home is, what do you want your out-of-pocket expenses to be? What do you want your monthly payment to be? And that's going to determine your purchase price. And so I'm always a proponent of keeping that housing expense as low as possible. And so for us, part of that is getting the fixer-upper. If we get the fixer-upper, then we're buying a house that is going to cost less than what a fully renovated house is going to be, or what a new construction property is going to be. And that plays into a couple different things as it pertains to my long-term strategy. If my mortgage is low, then I'm going to get more profit when I eventually rent the property out. The main criteria that I have for whichever property we decide to buy is the mortgage going to be less than what people are paying for rent in this area? If it doesn't meet that criteria, I'm not buying it because it doesn't fit within my long-term plans. If it's close and the property is great, checks all my boxes, I'll consider it because I know eventually rents are going to continue to go up. But for me, that number is most important. And so that's why I almost would rarely ever buy a flipped property, a property that has been renovated, because I know that whoever put in that work is taking the profit. They're taking the equity out. And so I know that the property that I'm going to end up buying is likely going to be a fixer-upper because I can buy it for under market value. It's going to keep my mortgage lower than it would be. And then gives me an opportunity for that to be a good investment down the line when we eventually move on from that property and buy something else. I'm not too concerned about interest rates because I can't control it. I'm not going to let interest rates determine my buying strategy. It doesn't make any sense. If there's nothing I can do to control interest rates, so whenever I have my credit together, whenever I have my savings up, that's what I'm going to buy. I would hope it's in a time period in which rates are lower, but because I can't control it, I can't guarantee it, I just got to move within the market that I'm in. Same thing goes for inventory. I don't know if inventory is going to be through the roof and we'll be able to get a good deal, or I don't know if inventory is going to be down and we're going to be competing with multiple buyers for the same property. I can't control that. I can control my credit. I can control my savings. I can control my strategy. I'm not going to be worried about that other stuff because I'm in it for the long haul. Right? This is a property that I'm adding to my portfolio. So 10, 15 years down the line, when I say, hey, I have 20 properties, I got 30 properties, I got 15 properties, whatever, I know that I didn't push that goal out further because rates weren't where I wanted them to be. So some of the prep work that you want to do before you hire an agent is getting financially ready. We spoke about that, right? Getting your credit together, getting your cash reserves, your savings to a point in which makes sense, and use a high yield savings account. That's an easy pro tip. You shouldn't be putting large sums of money in a regular savings account. Let your money make money for you. In a high yield savings account, you can make 3%, 4%, 5% on your money and get your savings goals faster. I don't put large sums of money in my regular savings account. I have maybe like $500 there. Everything else is in a high yield savings account. So I recommend you guys do the same. You can Google it and find whichever one you want to do. Open the account and let that be all your savings account should be in high yield savings account, but just something to consider if you guys aren't doing that yet. Market research. You don't need an agent to go to an open house. So before you go out and hire an agent, go to open houses, start looking at properties, get a better sense of the inventory, understand the market. How long have these properties been on the market? What are these properties selling for? This property's $350 and this property's $325, but they're on the same block. What's going on here? The only way that you're going to be able to get a sense of inventory and the pricing is by actually seeing the property. I tell agents this all the time. If you don't have any clients, you still should be going out and getting to know and understand the inventory. Because once you do get a client, then you'll be able to express to them exactly what I'm saying. Like, what are the differences between pricing? Like, is this seller crazy? Are they just pricing it high because they want to make some money? Or is this house actually truly better than the one down the block? Those are things that you can be doing, prep work that you can be doing before you hire an agent and before you even, pre-approval letter. You guys, so this is just the beginning of my home buying journey. And I plan to keep this going and be really transparent with you guys of, I'm experiencing and what I'm doing. So as my numbers change, as the market shifts, as the decisions I make become more and more real, I'll continue sharing what I'm learning and adjusting my strategy and all that good stuff. If you're buying a home or strongly considering it, come along on the journey with me. It's going to be messy. Things are going to change, but that's why we stay flexible and we can be each other's accountability partners. So if there is any questions that you guys have as you're going through this process, or maybe you want to talk about long-term strategy and different things that you can do, give me a call or, drop them in the comments. Let's have a conversation about it. I'll see you on the next one.